Hello, and welcome to another episode of the Seasonal Tokens Podcast, where Polar interviews people so you can do more investing and less gambling.
Sounds to me like the dream of every trader to know when the price is going up and when the price is going down, because you can plan your investments. Isn't this what we actually want in all of our investments?
Yes, it is. It's exactly what we want, and it's hard to get into another investment. It was kind of a discovery of mine that it's possible to do this with cryptocurrencies.
Yeah, it definitely sounds like out of the norm. So it's very interesting how you have even gotten to this idea that this is possible.
So it was really, I wasn't sure that originally I was trying to make a copy of Bitcoin that could be used so that when Bitcoin Bitcoin once every 4 years, it goes up in price after the halving takes place and the supply gets cut in half, and then the market needs to adjust, and over the course of the next year the price rises, but then it stops rising and will often start to fall, and we've seen that happen again and again, including recently. So what would be good would be to have another coin that you could switch from Bitcoin to this other coin, and if this coin was just like a copy of Bitcoin but was just delayed by a year, for example, then that would mean that when Bitcoin is going up over the year following its halving, then after it reaches its peak, you could switch to this other coin and it would just be beginning to rise in price because of its halving. But you can't do that, because you can't just conjure another version of Bitcoin into existence, because Bitcoin has maybe $500 billion market cap, and this other coin would need to have a similar market cap in order to be able to fulfill this function. So, but what you can do is you can make 4 new coins and 4 new tokens, and basically arrange them in this way, and then they all start off with the same market cap, which is 0 initially, but they grow together and they stay in a system and they're perfectly sized for one another, and so on. But can you remind me what the question was again?
Yeah, so how you have actually come up with the idea to create something like that?
Right. Yeah. So, the original motivation was because I was looking at my own Bitcoin investment, and I was aware that in 2022 and 2023 it was not going to be good, and but I was aware that like 2021, so 2020 would be a good year, or the end of 2020. The end of 2020 and the beginning of 2021 and so on, those would be good because the price would be responding to the halving that happened halfway through 2020. But after that, it wasn't going to do so well. And so I could see this coming. So as early as maybe 2019, I was thinking that I needed to do something to avoid losing a lot of money in this upcoming Bitcoin crash. So the options were to sell the Bitcoins for dollars, which is something that I didn't want to do. One of the reasons is I would have to register a capital gain, and I would have to pay tax on that. But the other option was to invest in another altcoin. So basically, to look around and find a coin that looks promising and then invest in this. But I didn't want to do that because the reason is that's kind of not. If I pick a coin that I think is promising and I think the price will rise over time, the reason that I'm going to think that is because I expect there to be growth, and I expect there to be user adoption, and I expect there to be popularity, and I expect the public to find it interesting, and so on. But all of those are very uncertain things. It's basically betting on what the public is going to do, and betting on what's going to be popular, and that is basically a gamble. Whereas the reason that Bitcoin's price goes up once every 4 years is because the supply gets cut in half, and that's very reliable and solid. It's not a bet. You don't have to speculate much to expect that the price of Bitcoin will rise after the rate of supply gets cut in half. So Yeah, so basically that was the situation that I was finding myself in, and I realized that the ideal solution to this would be to have another investment that I could switch from Bitcoin to, which would then be like a delayed version of Bitcoin, and that would be a way to escape from the bear market. That's whatever comes after Bitcoin's bull market. And but because it's difficult to do that with Bitcoin, I created the 4 tokens using smart contracts, and I was actually able to do that because smart contracts, tokens that are produced by proof of work mining had recently been introduced in 2018. OX Bitcoin came into existence, and it was a mineable token. So most of the cryptocurrencies that are mined, the mining is, and the proof of work is used to secure the blockchain, and that's basically one of the major purposes of it. But with mineable tokens, the blockchain is the Ethereum blockchain. So you don't need the proof of work to secure the blockchain, and instead the role of the proof of work is to provide a cost of production to the tokens, which supports their economic value. So basically, it was because OX Bitcoin had found a way to implement proof of work mining with tokens that it was easy for me to create seasonal tokens. Because when I initially tried to make a copy of Bitcoin, what I found is that there are 40,000 lines of code, and it's incredibly complicated, and it's written in C++, which is a language that's not nice to read, and it's written in Hungarian notation, which is a very strange and obsolete way of writing code, and makes it unpleasant to read because all of the variables look like strings of random letters, and it's very hard to understand what's going on. So, and also when you want to make a cryptocurrency like Bitcoin by forking the code and setting up a new blockchain, you also have to set up a peer-to-peer network to distribute the blockchain. You have to have wallet software. You have to have block explorers. You have to have a website where people can explore the blockchain. And setting up all of that is very complicated and expensive. And what also you have to do is you have to have enough mining power to prevent 51% attacks, where somebody who has more computational power can rewind your blockchain and reverse transactions and effectively steal money. So in order to prevent that from happening, if you are starting a new blockchain, you have to keep the hash power high enough that other people can't feasibly get more hash power. So you have to be basically one of the biggest entities out there in terms of hash power, and in order to support hash power at that rate, it would be necessary probably to rent it, and that would mean that there would be a continuous ongoing expenditure of money just to rent enough hash power just to keep the blockchain secure. So basically trying to do something like seasonal tokens, where each token was a cryptocurrency coin with its own blockchain, and using proof of work to secure the blockchain, that's something that would fail eventually. And so, yeah, basically that's why I decided to use the smart contracts once I realized that it was possible to do it that way.
Okay, yeah, so it sounds like a very innovative way to achieve one of the dreams of the investors, actually the dream of all investors. That's for sure. I hope that this will come true. We'll find out very soon. I think that I have heard the answers of this question, but what are actually the main differences between seasonal tokens and most cryptocurrencies?
Well, most cryptocurrencies, that covers a lot. I think the difference between the tokens and other mineable cryptocurrencies is that the tokens are smart contracts and they're running on the Ethereum blockchain, so the proof of work mining isn't used to support the security. And the difference between the seasonal tokens and most other ERC20 tokens that are issued on Ethereum and other blockchains, the difference is that the seasonal tokens are mined using proof of work, and most of those aren't. So that's, I suppose, the main structural difference between seasonal tokens and either cryptocurrencies that are mined or tokens that aren't mined. But the other difference, I suppose, from an investment point of view is that if you're investing in another cryptocurrency, then what you're doing is you are expecting the price of that cryptocurrency to go up, or that's where you expect to get your profit. You're going to buy the cryptocurrency and hold it while the price rises, and then sell it and make a profit. And that's the way that it's intended to, or that usually works. Whereas with seasonal tokens, there's a way for you to make a profit that isn't dependent on the prices of the tokens rising over time. You don't need continual price rises in order to make an ongoing profit measured in tokens. What you can do is you can sell tokens for more tokens of a different type. And so you can trade winter tokens for spring tokens, for example. And because winter is more expensive than spring, you get more tokens in total. And then you can do that again later. You can trade spring for summer, and then you can trade summer for autumn. When each token goes from being the cheapest to being the most expensive, then you can trade it for the cheapest token, and then you get more tokens in total. So because you can continue to do this, that means that the number of tokens in the investment continues to increase over time. And that means that you don't need to rely on the prices of the tokens increasing because the number of tokens is increasing. So your investment can grow in value even if the prices of the tokens stay approximately constant over the long term.